Last Friday, July 31st, the United States government bought Japanese yen for the first time since the 1998 Asian financial crisis. This came as a response to Japan's finance ministry, which, the day prior on Thursday, sold foreign currency out of the national reserves and bought yen to support the yen. Each purchase is meant to slow the yen's collapse. Japan's finance ministry confirmed the coordination on Monday. It said it acted pursuant to the U.S.-Japan finance minister's joint statement issued in September 2025 against excessive volatility and disorderly movements. That statement also commits both governments to disclose their interventions monthly. The yen had fallen to near 164 to the dollar, its weakest in 40 years, and by Friday, it rebounded back to around 157. On CNBC on Tuesday earlier this week, Treasury Secretary Scott Bessent explained why the U.S. made this historic move. Take a listen.
In the late 90s, 97, 98, the Asian financial crisis, in my opinion, part of it was triggered by an overly weak yen. So I think a stable yen is not only important for the U.S., but it's very important for the entire region, because if the yen were to weaken substantially, then the other currencies would follow it. We'd seen excess volatility in the Korean won. Many people believe that the Chinese RMB is undervalued. So, given the trade flows, given the size of the economy, given their contribution to the global savings market, very important to have a stable yen. That the Japanese government understands that, and we are proud to stand with them in implementing their policies and help them stabilize the region.
And here's a rationale President Trump gave.
We have a good relationship with Japan. We're very strong, very, very strong financially. And they are, they have a weakening yen, and they wanted a little bit of help. And we're always there for Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor.
Mr. President,
they were not good.
What is the U.S. getting out of that arrangement?
Financial benefit. Financial benefit. It's also good for the world economy.
Now, there's one detail that a lot of media outlets didn't lead with. The New York Fed, acting for the Treasury, did not sell dollars to buy yen. It sold euros instead. The idea is to lift the yen without signaling that Washington wants a weaker dollar. So not everybody was impressed with this. Edwin Truman, a former Treasury official, called the move weird. The Brookings Institute economist Robin Brooks said the twist undercuts the efficacy of U.S. participation. Now, it hasn't officially been confirmed how much yen was bought exactly, but at Camp David last week, a Reuters photographer caught Treasury Secretary Bessent's to-do list: buy Japanese yen, $5 to $10 billion. It was the only figure anybody had at the time, and speculation ran throughout the weekend. So, on the yen depreciating itself, why has it been tanking? So to understand why this bailout happened in the first place, let's get some background on the yen itself. The yen has been sliding for 5 years. In 2021, it averaged about 110 to the dollar, and last month it touched 164 before snapping back. The standard explanation is interest rates, as money tends to move to where it earns more. In 2021, the American 10-year Treasury paid 1.45%. The Japanese 10-year paid 0.07%. Then the two diverged. By 2023, the U.S. yield had nearly tripled to 3.96%, while Japan's had barely moved, still at 0.57%, because the Bank of Japan was capping it on purpose. That gap is what built the carry trade, and it peaked in 2023 at 3.5 points. Now, the gap has been closing ever since, and today the gap sits around 2 points. Meanwhile, the Japanese yen kept falling anyway. The IMF said the same thing in February. The yen had generally tracked the U.S.-Japan yield differential in recent years, it wrote, but has consistently decoupled since mid-2025. And Japanese yields are not creeping higher. In May, the 40-year bond went above 4% for the first time since Japan began issuing it. In July, the 10-year hit 2.8%, its highest since 1997. The deficits are widening in the meantime, and in June, the government passed a supplementary budget of more than 3 trillion yen, funded by issuing more debt. And on July 30th, it revised its own debt forecast upward to 187.6% of GDP this fiscal year, up from 186.6% in January. And it has roughly committed to 10 trillion yen a year of additional spending from next year onward. The reason is contested. Some analysts read it as the market pricing fiscal risk rather than growth. Prime Minister Takaichi's government approved a headline 21.3 trillion yen package last November, with 17.7 trillion in actual spending. One potential other reason is energy. After US and Israeli strikes on Iran began on February 28th, Brent went from about $71 a barrel to a peak of $138 in early April. Japan imports almost all of its energy, and by June, its petroleum import bill was up 59% on the year. Japanese households are also sending money abroad on purpose. Net inflows into retail investment trusts topped 6 trillion yen in the first quarter, a record driven by the country's tax-free NISA accounts. Every yen of that has to be sold to buy something else. So here, Steve Hanke, professor of applied economics at Johns Hopkins University and a regular on my show, explains the yen depreciation in his own words.
We've never had a Secretary of Treasury in the last 30 years that's intervened in the currency market to support the yen one way or another. Now we do. So it makes people move away from market fundamentals and what's behind this yen going down. And they're looking at the big player, who's Besson and Trump. Well, what are they thinking? What's going on? So that is market manipulation. The big player comes into the picture, and all of a sudden, the analysts and the traders start looking over their shoulder and wanting to know, well, how's the big player going to manipulate the market tomorrow? Or is he? What's going to happen? And they stop looking at fundamentals. Fundamentals point to more yen weakness. That's where the fundamentals come into the thing.
Now, to understand why Japan cannot simply raise rates and be done with it, we have to look at the country underneath the currency. Japan is the world's fourth largest economy and its most indebted government. Gross government general debt is about 207% of GDP. That measure ignores the government's own financial assets. Count those, and the net debt is approaching 137%. Still among the highest anywhere, but not the number you usually hear. And the largest holder of that debt is the Bank of Japan. It owns about 48% of Japanese government bonds, up from 12% in 2013. But that share peaked near 54% in 2023 and has fallen every quarter since as the bank tapers. Then the demographics are important, which are the real constraint. Last year, Japan recorded about 706,000 births against 1.59 million deaths, a natural decline of nearly 900,000 people. The population fell by 440,000. Immigration made up the difference, but nearly 3 in 10 Japanese are over 65, the oldest of any large country in the world. The working age population peaked in 1995 at 87 million, and it's now at 73 million. On the government's own projection, 87 million people is what the entire population will be in 2070. This is the engine underneath the carry trade. An old, shrinking, high-saving country built up enormous financial assets. Japanese households hold 2,386 trillion yen, and 47% of it sits in cash and deposits, earning almost nothing. The Bank of Japan's own research ties an aging population to lower interest rates, though how much it explains is contested. Some economists argue aging pushes rates up, not down. Before we continue with the video, I'd like to tell you about a new opportunity to be exposed to gold and silver. Today's sponsor, ICG Silver and Gold, is one of Nevada's newest silver and gold exploration companies, having gone public earlier this year. Their flagship project is in the Tuscarora district, a district-scale silver and gold project sitting at the intersection of two of Nevada's best-known gold belts, the Carlin Trend and the Independence Trend, with both open pit and underground potential. The project sits only a few kilometers away from First Majestic's Jarrett Canyon mine, which is on track to restart production next year. The Tuscarora district is an advanced exploration asset. There's more than 40,000 meters of historic drilling on the project, including a past intercept of 4.57 meters of 127 grams per ton gold and 1.5 meters of 367 grams per ton silver and 52 grams per ton gold. The company is now drilling 3,000 meters at the first 10 targets and is aiming to release the project's first inferred mineral resource in the first quarter of 2027. To learn more about the project and the company, check out the link in the description down below. And as always, review the company's filings and risk disclosures before making any investment decisions. So now that we've taken a snapshot of the Japanese economy, let's now explain why the Japanese carry trade is significant for US markets. To recap what a carry trade is, it's essentially you're borrowing money in a foreign currency at a lower interest rate and investing it in another currency's markets at a higher interest rate. Suppose you're an institutional investor and you borrow $1 million in Japanese yen at a 1% interest cost. You then take the $1 million and invest it in US treasuries yielding, let's say in this example, 2%. So that difference between 1 to 2%, that's your profit in this case. So essentially, my borrowing costs are tied to, in this case, Japan's interest rates, which have historically been low relative to other markets like the US. Two things make it dangerous. It only pays if you borrow heavily, and two, it only works while the exchange rate stays put. The Bank of International Settlements says these trades are often portrayed as picking up nickels in front of a steamroller. For 25 years, Japan was where money was cheap. Between February 1999 and March 2024, the Bank of Japan's policy rate never went above 0.5%. That ended on March 19th, 2024, with the first rate hike in 17 years. Most of the trade runs through derivatives rather than loans, and the BIS counted $14.2 trillion of yen swaps and forwards outstanding at the end of 2023. Almost none of that is a carry trade, however. Its own arithmetic gets from that number down to roughly $160 billion of speculative positioning. So how big really is it? Well, nobody knows for sure. That's not an invasion, it's the answer. The BIS called the size difficult to measure and put its middle estimate at $250 billion going into August 2024, and added that the figure is biased down due to data gaps, so it could potentially be even higher. This is what people are referring to when they talk about a yen carry trade unwind. Essentially, an unwind is this kind of trade in reverse. Sell the treasuries, buy back the yen, and take the loss if the yen has risen. So imagine this scenario that the Bank of Japan raises interest rates, and interest rates along all ends of the curve go up. Well, all of a sudden, if you borrow it at 1%, it's no longer 1%, and you're now at a loss. So when thousands of investors do that at once, each yen they buy pushes the yen higher, which forces the next one to sell. An unwind actually did happen 2 years ago on August 5th, 2024. The Nikkei fell 4,451 points, the biggest one-day drop in its entire history. In percentage terms, that's 12.4% in a single day. The S&P 500 also fell 3%. That's huge. Before the US opened, the VIX printed almost 66. Michael Gayed, founder of the Lead Lag Report, actually called it on my show way back in 2023. And this is what he said back in 2023 if the yen carry trade unwinds. He said it best.
It means we're all I don't know how else to say it. It's like, no, but really, it's I'm making light of it because I think it's funny, legitimately, and I think you have to have humor in the face of what could be a crisis that nobody can really fully control, just try to manage through, right? But like, this is the point. It's like it's more than just the Fed. Liquidity is more than just what the Fed says and does. It always is. So that IMF paper is interesting because it would suggest that the yen carry trade was actually a bit of a catalyst also when it came to the subprime crisis. Right. Again, butterfly flapping its wings, Mothra in the case of Japan. And I mean, I get it. Godzilla ultimately won, but he got his ass kicked for a bit.
And then on August 5th, 2024, I invited him back on my show to recap what just happened in global markets.
The idea was very simple, right? You have a monetary cycle mismatch between the Bank of Japan, which is the world's enabler of leverage through the carry trade, and every other central bank around the world. And that at some point, the yen would squeeze higher, cause a reversal of the carry trade as money panics, as Japan panics, which is clearly what's happening now. And that would have all kinds of nasty reverberations. I call Japan the Mothra, not the butterfly flapping its wings to creating the hurricane in a chaotic system. It's the Mothra from the Godzilla movies. So it looks like in the last 3 trading days, that's exactly what's happened. You've had some shocking moves, seemingly out of nowhere. I looked at it this morning. It's like the VIX crossed, 60, I think it was, at the peak before, just as the market was opening. Now, this is, I think, very, very tricky, extremely tricky. I go back to, again, path matters more than prediction. The problem here is people are under the assumption the Fed's going to step in and print money. And you know what? It makes sense that they're going to have to try to ameliorate some of this volatility, which seemingly came out of nowhere. But again, the conditions have been there for a better part of a year. They just happened suddenly. The problem is that this is actually very much a catch-22. If the Fed lowers rates in response to the reverse carry trade, that actually narrows the interest rate differential between Japan and the US. That interest rate differential is what is causing the yen to fall, or what caused the yen to fall before, and now is actually causing the reversal of it. So if the interest rate differential is narrowing, that's actually yen supportive, which could actually accelerate the reverse carry trade even further. So I suspect there's going to be some degree of intervention, some kind of swap line or something's going to be announced just to kind of cool things off in the short term. But the cat's out of the bag, right? It's like once you have a deleveraging process like this, it's very hard to really contain it. And this was the whole thesis I had with you when I was joking about the whole world being by this. I said, you have to laugh about it, okay? But it's a very serious situation because it's going to be very hard to manage.
So how does today compare? Well, the rate gap is half of what it was. In 2024, it was more than 5 points. Today, it's about 2.6. That sounds safer, but it may not be everywhere. The BIS notes that carry-to-risk ratios on the Mexican peso and Brazilian real against the yen peaked earlier this year. It reads that as a rising risk that the funding currency appreciates. Positioning says something similar. On July 28th of this year, speculators held a net short of 163,000 yen contracts. That's 89% of the peak going into August 2024. When it does travel, the route runs through margin calls and risk limits rather than a direct wire from Tokyo to NVIDIA, let's say. The BIS says the 2024 Unwind triggered further spillovers into the United States, channeled in part by leverage trades of speculative investors like hedge funds that used yen funding. But interestingly, the Federal Reserve's most recent financial stability report does not mention the yen, Japan, or the carry trade even once. Its survey of 20 market contacts lists 13 risks, and this is not among one of them. So here are 3 dates to watch. Japan publishes its official intervention total at the end of August. The Bank of Japan meets on September 17th and 18th for its next policy rate decision, and the next Treasury holdings release will show whether Japanese investors are actually coming home. What happens then if the yen carry trade unwinds again? Well, a lot of market commentators have talked about this. Here's Peter Schiff, Chief Market Strategist of Euro Pacific Asset Management, on his own show on YouTube, giving a prediction of how it could impact U.S. markets.
Investors that are going to sell U.S. assets, including treasuries. The Japanese government owns over 1.1 trillion in treasuries. The Japanese government is the biggest owner of U.S. treasuries in the world. So if the Japanese government is doing the right thing, one of the things they need to do to shore up the yen is pay down some of their debt. Well, how do they pay down their own debt? By selling our debt. And that also helps with the yen. Now, they'll give up the income that they're earning on U.S. government bonds, but that's not that much. And in fact, if Japanese bonds rise, they may be able to have the same income on those bonds, right? As those bonds are maturing and they get higher yields. So, it's going to be a win for the Japanese to dump our bonds. Well, that's a huge loss for us when that happens. So the stock market here can crash, the bond market, the economy, we can have a financial crisis that starts in Japan. Now, maybe the Japanese don't do the right thing. Maybe they just leave interest rates alone. Or maybe the Bank of Japan just goes up to 1.25. That's not going to be enough. You could have a crash in the yen. Now, that's not going to immediately drag down the dollar, but it's going to crash the Japanese bond market, which is going to have implications for the U.S. bond market.
And here's David Nikoski, CIO of Vermilion Research, giving his take on my show earlier this week.
We don't have yield curve control. The Japanese government, interceded in the currency market a number of times and failed. I think they needed a joint effort with the U.S. to actually turn the tide there and actually, get that to move in the direction that they really need it. But if you do have this yen carry trade, the strengthening of the yen and yields moving higher should collapse that yen carry trade, or at least make the risks much higher with what's happening here. So it's almost like the U.S. government is trying to force the unwind of the yen carry trade with what they're doing, because everything that's happening is not advantageous for the yen carry trade right now.
So what do you think? If you were an FX trader, would you be a buyer or seller of yen at current levels? Do you think that the yen carry trade could unwind anyway, despite the US intervention, and ultimately cause a sell-off in the US markets? Is this the start of another Asian financial crisis? These are all topics I'll be exploring on my show this week and next. But for now, comment down below what you think is going to happen. And as always, thanks for watching. Like and subscribe to get daily financial updates.